Hello and welcome back to another episode of the Investor Financing Podcast. On today's show, I have Bill here with me, and we're going to discuss, we got a series of questions on some of the new guidelines that have changed within the SBA. There's a lot of changes going on. Some took place May 11th, and there's a bunch of changes that are happening in August. So we're going to dive into some updates, and Bill's got a series of questions. So we're going to talk all things SBA and what's going on, the pros and cons of what's going on with the changes.
All right. So the first question is, what were the guidelines in the past regarding partial changes of ownership in a business?
So in the past, you had to have 100% complete change of ownership. And now what's exciting is you can have partial change of ownership. So for people that are watching this, what it might mean is that, let's just say an owner is retiring, but maybe wants to stay on board because loves the business, just is getting older. They can sell a partial interest in the business. So maybe currently they own 100%. Well, maybe they can become a 19% owner and leave some of their equity in the deal. And the new buyer could take 81%. The old seller may not have to sign the personal guarantee. So it's going to be interesting to see how this plays out. But in theory, you could potentially structure 100% finance deals with the seller leaving a portion of their equity in. So it's going to be interesting to see how lenders actually react to these changes, because most lenders still want to see skin in the deal.
All right. So you kind of touched on this at the beginning, but when do the changes discussed take effect?
So some of the changes took place May 11th, while the majority of the bigger changes take place August 1st of this year.
All right, good. What were the rules regarding seller contributions toward the down payment in the past?
Sellers could leave potentially 5% on standby, meaning for the term of the loan. This, I think, started in 2017. They could leave 5% on full standby. So what that means is, for the term of the loan, they couldn't get payments. It could accrue interest, but they couldn't get payments, and there couldn't be a balloon payment. It had to be the same term as the loan. So if it was a business acquisition, it was a 10-year term. The loan, they couldn't get payments. There couldn't be a balloon payment for that whole term. Well, now the loan only has to be on partial standby for 2 years. And so that takes place, I believe that changes August 1st.
Okay, next up what was the requirement regarding the seller's duration of staying with the company after selling it in the past?
In the past, the seller was allowed to stay with the company for a maximum period of 12 months. And now with what we were just talking about previously, the seller could stay on for as long as possible. But most of the time, it would be good to have some kind of period where they're gonna wind down, but really they could be with the company indefinitely.
Okay, can a buyer purchase a business with zero money down?
Well, with the changes of the SOP, in theory, yes, they can purchase with zero down. It looks like, and obviously this hasn't been tested as of my knowledge as of yet, but the seller could potentially, now with this change of ownership, you could essentially do 100% finance deals if the seller put 10% on standby. So it'll be interesting to see if that, most lenders, I don't think will allow, I think they're going to stick with the 5% on standby rule. So I think they're still going to want to see 5% in, although who knows, maybe some of these deals will get done that way.
What changes have been made regarding the personal liquidity rules?
So in the past, we have a credit elsewhere test. And so they would decline loans. Let's just say the loan was $500,000 for an SBA loan, and the borrower had $4 million in the loan, $4 million in the bank. In the past, they wouldn't do that loan because of the credit elsewhere rule. So now they're according to the changes, that's not going to apply anymore. So you could have millions of dollars in the bank and still get an SBA loan. So that's a big change.
Okay. We've heard that the SBA directory that used to be in place is now no longer used. Can you tell us a little bit about that as far as how it was used, whether you think current lenders will continue to use it, even though the SBA isn't going to be using it, nor will they be updating it, and stuff like that? Just give us some background and your thoughts.
So we had it approved on the SBA website. You can go and you could Google approved SBA directory, and they took it down now. And essentially, that was a list of all the franchise concepts that were on paper approved, and that made it easier for lenders to make a loan. They would check what it said in the directory, and then they would have kind of a basis of other franchises that have been approved in the system. Now, SBA didn't approve it, meaning they didn't vet the franchise concept out and say, oh, this is a great concept. They just approved it from kind of a lending standpoint. And so now they got rid of the franchise directory. So what does that mean? That's a good question. I don't think it's been tested enough yet, but essentially I still believe that every lender is going to take a little bit of time to try to figure out. They're going to go back and they probably have a saved copy of the directory on their desktop or on their computer. They're probably going to see if it was approved still, I would imagine. But I think ultimately it's going to open up the door that any business franchise, whether it's a newer concept that only has 1 or 2 units or it's an established franchise, they're all going to have hopefully an honest look that, like, if the business merits an SBA loan, the borrower is going to be able to get potentially SBA financing. So they're going to have to rely on just prudent lending, where they're going to go through the franchise disclosure documents. They're going to review the business on its merits and the concept. And I do think ultimately it's going to open up the door, because we're seeing a big push for franchises right now. More and more people wanting to get into the franchise industry. They're looking to start their own business, and what better way than a proven model, or a model that has blueprint for them. So I do think ultimately it's going to be a great thing, but I do think there'll be some pain as these banks and SBA lenders are trying to figure out how to underwrite these type of franchise concepts.
What concerns do lenders have regarding the new SBA loan rules?
Well, I think lenders, first off, have concerns about the zero down payment rule and the potential increase in defaults. This is implementing more lenient rules can lead to higher default rates, and lenders want to avoid risk. So obviously there's some pushback, and I know Congress definitely has expressed concerns about the SBA's rule changes and potential risk associated with these riskier loans. So it's really interesting how this is going to play out. I do think, at the end of the day, on this show, we always talk about overlays, how these banks overlay the guidelines anyway. So they always seem to put the onus on the lender, saying, you need to use prudent lending, right? So is prudent lending letting borrowers buy into a business, or buy a business with no money or no skin in the deal? That's a good question. It's kind of like a happy medium. I believe that the SBA's programs are really good because it can help small business owners, and it can help aspiring business owners get the opportunity to purchase business and build legacy for their family. So very important. At the end of the day, I think there's going to be a happy medium. I don't think we want to get into a extremely risky scenario again, because at the end of the day, what happens if all these loans start defaulting? Really, the onus is on the American taxpayer. So it's yin and yang right there.
Yeah. How might the new rules benefit key employees who want to buy a business?
Okay, so many times we get this kind of call from Joe that works at the auto body dealership, and Joe's been working at the auto body dealership for 20 years, and he knows the business inside and out. He might not have the available capital. So what this partial what the new rules allow for is for an owner to still own a certain portion of the business and leave his or her equity in the deal, allowing for Joe to own the business and get ahead in life. And I think that's a really good rule that we're able to structure deals like that. I mean, I think underwriters can kind of see, like, this person's been running the business. They just never really have gotten ahead where they have maybe a huge capital injection to put in. So I think these type of deals, when it's a common sense kind of underwrite, like, this person's been running this business, it's highly unlikely that it's going to go under when somebody that's been pretty much running operation day to day. So I think it's a good thing. Hi, if you'd like to book a call with me and discuss SBA financing, whether it's a 7A or 504, or you just don't know where to start, maybe it's a startup business, you're buying an existing business, you're buying a franchise, you're building a new office building, you want to expand your existing business, we have multiple solutions. I can walk you through the 7A and the 504 and the SBA loan process. And if you have any other questions on any other types of financing, I'm happy to book a call with you. The link's below. Look forward to seeing you soon.
All right. What should business owners, buyers, and brokers do to take advantage of the new SBA loan rules?
I think I'm always learning, and that's what I love about SBA is that deals come into me and I work with a network of really competent bankers. And so just really figuring out what will work and what won't work with certain banks is kind of what I do for a living. It's like, okay, like, I am not preaching I'm an expert in SBA because I'm constantly learning. I'm constantly like taking classes. But what I do really well is I ask questions and I know what potential red flags might be in a deal. So I'm asking those questions to my BDO, my business development officer at that particular bank. And that, I think, is my competitive advantage, is helping individuals that want to acquire a business navigate the waters to get the bank that understands the deal and likes the deal and just getting to the finish line. Well, I appreciate it. Thank you for watching the episode. There's a lot of changes going on. I'm still trying to get the interpretations. I'm a member of NAGL, which is the National Association of Government Guaranteed Lenders. I'm probably one of the few brokers that's involved, and I'm taking classes there, and I learn a lot. There's a lot of changes, and at the end of the day, the bankers still are, and the underwriters still need to make prudent lending decisions. And so, even though these guidelines seem amazing, and I'm excited to help structure deals, the loans have to make sense at the bottom line. So what do we do to make ourselves strong borrowers? What are the compensating factors of the deal? And oftentimes, some of the stronger deals have commercial real estate, right? So if you have a deal with commercial real estate versus a deal with just all intangibles or just what we call goodwill, it's just you're doing a business acquisition with no real collateral. Those are a little bit tougher deals. So if I'm buying this business and it's all intangibles or goodwill, and it's a $3 million business, what other compensating factors do I have? Have I been working in the industry for a long time? Do I own primary residence with $1 million or $2 million of equity? Do I own rental properties? Because remember, if there's a collateral shortfall, the lenders, based on the SBA SOP, they're going to look for additional collateral to cover the shortfall. So what compensating factors are in the deal? What do your projections look like? Spending time building your projections. On SBA loans, we always want to do 3 years of projections, the first 12 months broken out month to month. Your business plan. What's your business plan? Maybe the cash flow is really tight. The debt service coverage ratio is not strong. But what are we doing to do some value add? And so, like, we have one deal right now, for example, where the cash flows, the debt service is tight, but we're doing a lot of value add. And so we're, buying the business for $1.2 million, and it needs $300,000 in CapEx. It's a boutique motel. So what can we do to strengthen the deal? So obviously we got collateral. There might be a collateral shortfall, and the borrower has some additional rental property, so potentially they can put a lien for the collateral shortfall. But kind of navigating all these questions, and really getting in with really experienced underwriters and BDOs is really the key. So I am constantly networking with different bankers. I just on the phone today with a lady who's been in the industry for 22 years. She used to trade the bonds for the SBA guarantees. Got a lot of experience. So I'm constantly networking with these banks. And when I'm interviewing these bankers that I want to work with and help facilitate these deals, I'm finding out what's your sweet spot for your bank. And I said, oh, will you do pari passu? And their bank won't do pari passu. What are you strong at? Well, we do a lot of franchises. So these are the questions. So when a new deal comes in, that's how I navigate the deal. I usually almost immediately have one or two banks in mind when a deal passes through when I'm talking to a potential borrower. And then I usually put together a kind of loan summary and then have a conversation with that banker and say, hey, what are the chances? Is this really a deal that will fly through your underwriting department? And at the end of the day, SBA loans are a little bit challenging, but if it's a make sense deal, they're going to get done. And if you package it right, and we've had a couple instances where we've taken to one bank and they declined it. And then we took that same package to another bank and they approved it. So the point being is it's all about appetite on these deals, and knowing which lender to bring it to is really important. So anyways, that was kind of a long-winded summary of our episode, but I hope you enjoyed this. We're going to bring you updates as we learn more as we go through the process, as we see what actually happens with these changes. Will banks actually loosen up? How are people structuring these deals? And I do think right now it's going to be a big time to go after retiring business owners. There's going to be give or take 12 million businesses over the next 10 years that are going to be changing hands. And wouldn't it be nice if you were one of the lucky ones that buys a great cash flowing business and get out of your W-2 job and live the good life? So anyways, hope you enjoyed this episode, and thanks, Bill, for your help. We'll see you on the next one.
Thank you.
Hey guys, Bo Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.